Hello there, and welcome to the Sleepy Economics channel. Tonight we follow a single quiet thread through the fabric of human history, the thread of insurance, that old and gentle promise that no one has to face ruin entirely alone. For as long as people have loaded ships, planted fields, and built homes beside rivers that might flood, they have also found ways to share the weight of bad luck, spreading a single misfortune across many shoulders so that it never has to fall on just one. This matters because insurance is really a story about trust, about strangers agreeing, centuries before written law caught up with them, that they would rather carry a little bit of each other's risk than let any one person carry all of their own. It runs beneath merchant voyages and burial societies, beneath coffeehouses and actuarial tables, beneath grand government schemes and small village funds, all the way into the present. Before we begin, if stories like this help you unwind at night, consider leaving the channel a like, subscribing, or leaving a comment below. And tonight, before you drift off, tell us in the comments where in the world you're listening from and what time it is right where you are. For now, let your shoulders soften into whatever is holding you. Let your breathing slow, unhurried, patient, like a tide easing back from the shore. Let your thoughts loosen and drift, with nowhere they need to be. Let's begin. Ancient Babylonian merchants invented one of history's very first insurance contracts without ever using the word. In the valleys between the Tigris and the Euphrates, more than 3,000 years ago, traders who wanted to move goods by caravan or by river barge faced constant danger: bandits on the roads, storms on the water, and the simple bad luck of a broken axle far from home. So merchants borrowed money for a voyage under a special condition. If the goods were lost, the loan was forgiven entirely, and if the goods arrived safely, the lender was repaid with a much higher premium built in for the risk they had carried. The tension was subtle but real. Lenders had to charge enough to survive the ventures that failed, and borrowers had to trust that a stranger's calculation was fair, long before either side had any formal way to prove it. Even this far back, we can see the essential shape of insurance forming quietly, a fee paid in the good times, in exchange for protection in the bad ones. Imagine a scribe pressing a wedge-shaped stylus into wet clay, recording the terms of one such voyage loan for a merchant about to leave the city walls. This is the world where the Code of Hammurabi, carved in stone in the 18th century BCE, formally recognized these risk-sharing loans as legitimate contracts under law. The code specified that if a caravan was raided or a ship was lost through no fault of the traveler, the debt tied to that journey simply vanished, absorbed by the arrangement itself rather than by the ruined merchant. The unresolved tension here is that such generosity had to be paid for somewhere, and so the interest charged on surviving journeys was steep, sometimes startlingly so by modern standards. Still, the principle survived that steepness because the alternative, one family bearing the entire loss of a lost caravan, was so much harder to bear alone. Phoenician sailors, threading their narrow ships along the coastlines of the ancient Mediterranean, carried this same idea further out to sea. Sailing from ports like Tyre and Sidon more than 2,500 years ago, these traders depended on wooden hulls, woven sails, and a great deal of nerve to move cedar, glass, and purple dye across dangerous open water. Because a single storm could destroy an entire cargo and drown the hope of a family's fortune in an afternoon, groups of merchant investors began pooling their money across several ships at once, so that the loss of one vessel did not mean the loss of everything. The tension, of course, was that pooling money meant trusting partners you might never fully know, partners who could exaggerate a loss or quietly profit from another's misfortune. And yet the sea itself taught its own patience. Sailors who shared risk long enough came to understand that a little humility toward chance was wiser than any illusion of control. Chinese river merchants along the Yangtze developed an elegantly different answer to the same old fear of loss. Centuries before the Common Era, traders moving valuable goods downriver through dangerous rapids would divide a single shipment across several boats rather than loading it all onto one, so that no single accident could wipe out an entire fortune. If a boat capsized on the rocks, only a fraction of the cargo was lost, and the surviving boats carried enough profit to absorb that fraction without ruin. This was not insurance in the strict sense of a written contract or a paid premium, but it shared the same deep instinct that risk becomes bearable the moment it is divided rather than concentrated. In its own quiet way, it foreshadowed a principle that would echo through nearly every insurance system built afterward: the gentle mathematics of not putting everything in one place. The ancient Greeks, always fond of formal rules for their bustling trading world, developed a body of maritime custom that would outlive their own civilization by more than 2,000 years. On the island of Rhodes, a prosperous hub of Aegean trade, sailors and merchants agreed upon principles for what happened when cargo had to be sacrificed to save a ship. If goods were thrown overboard during a storm to keep a vessel from sinking, the loss was shared proportionally among everyone whose cargo survived, not borne alone by the unlucky owner of the goods that went into the sea. This idea, later called general average, seems almost mathematically obvious to us now, but at the time it required real courage to formalize, because it meant merchants had to agree in advance to share pain they hoped never to feel. This is what makes early maritime law so quietly remarkable. It grew not from abstract philosophy, but from the very practical fear of drowning with everything you owned. Imagine standing on the deck of a Rhodian merchant ship as a sudden squall rolls in from the horizon, sailors scrambling to lighten the load before the hull takes on water. The rule of general average meant that the merchant whose amphory of oil went overboard that night would not bear the loss alone. Every other merchant whose cargo survived the storm would contribute a fair share to cover it. The Rhodian sea law, though we no longer have its original text intact, was referenced for centuries afterward by Roman jurists who recognized its wisdom and folded it directly into their own legal thinking. Even the tension of loss, in other words, could be turned into something almost gentle, a shared debt rather than a private catastrophe. It is a small, steady lesson that would resurface again and again across the long history we are about to walk through together. Rome, ever a builder of institutions, absorbed these maritime customs and layered its own systems of mutual protection on top of them. Roman law recognized general average almost exactly as the Rhodians had practiced it, formally writing the principle into the empire's commercial code so that merchants across a vast trading network, from Britain to Egypt, operated under a shared understanding of shipwreck and sacrifice. But Rome's most tender contribution to our story had little to do with ships at all. It concerned death and the simple human fear of being buried without dignity or ceremony. Poor Roman citizens, soldiers, and even freed slaves began forming burial societies called collegia funeraticia, paying small regular dues into a shared fund that guaranteed every member a proper funeral, no matter how little they owned. In this quiet arrangement, insurance took its first steps away from cargo and towards something far more personal, the fear not of financial ruin, but of being forgotten. These Roman burial collegia met regularly, almost like small clubs, combining fellowship with financial protection in a way that feels surprisingly modern. Members gathered for shared meals, honored their patron gods together, and contributed modest sums each month into a common treasury managed by elected officers, much like a small mutual insurer today would manage its reserves. When a member died, the collegium paid for the funeral rites, the tomb, and sometimes even a small pension for the surviving family, drawing directly from the pooled contributions of everyone still living. The tension sat quietly beneath the surface of these gatherings. Younger, healthier members were, in effect, subsidizing the funerals of those who would die sooner, and everyone understood this without ever needing to say it aloud. It is a strange kind of comfort, when you think about it, to know that your neighbors have already agreed to carry you gently into the ground. As the Roman Empire slowly dissolved into fragments across Western Europe, the guilds slowly replaced the collegium as the center of mutual protection. Merchant and craft guilds, forming in cities across medieval Europe from roughly the 11th century onward, bound together weavers, goldsmiths, bakers, and traders, who shared not just a profession, but a common vulnerability to fire, theft, illness, and the simple hardship of growing old without children to care for them. Guild members paid regular dues into shared coffers, and in return, the guild would rebuild a burned workshop, support a sick craftsman's family, or cover the funeral costs of a member who died penniless. The tension, as always, was one of fairness. Guilds had to decide, often through long and heated meetings, exactly how much support a struggling member deserved, and how much the healthy majority should be asked to give. Even so, across hundreds of towns and centuries, this pattern of mutual aid quietly held medieval economic life together far more than most history books ever credit it for. Medieval guilds also pioneered something we would now recognize as a very early form of fire insurance, long before any formal industry existed to sell it. In densely packed wooden cities across northern Europe, a single kitchen fire could spread from rooftop to rooftop in minutes, destroying dozens of homes and workshops before anyone could organize a proper response. Craft guilds in cities like Ghent and Bruges created shared funds specifically earmarked for fire relief, so that a member whose workshop burned down would receive enough support to rebuild, rather than being forced into poverty or debt. This is what makes medieval guild life so quietly moving. It treated catastrophe not as an individual failure of luck, but as a shared cost of living closely together in a fragile, flammable world. The instinct these craftsmen carried, that community itself could be a form of protection, would eventually be formalized into contracts, premiums, and companies, but its heart never really changed. The maritime insurance contract, as we would recognize it today, first took clear shape in the trading city-states of medieval Italy, particularly Genoa. By the middle of the 14th century, Genoese merchants were drafting written agreements in which one party, for a fixed fee paid up front, promised to compensate another party if a specific ship or cargo was lost at sea during a named voyage. This was a genuine leap forward from the older bottomry loans of Babylon, because the insurance contract was now separated entirely from any underlying loan. It existed purely as protection, bought and sold like any other commodity in the busy port markets of Genoa and Pisa. The tension facing these early Italian insurers was one of information. With no reliable records of past shipwrecks or storm patterns, they were essentially guessing at fair prices, relying on instinct, reputation, and a healthy dose of nerve. And yet, from these uncertain beginnings, an entire industry, patient and slow, began quietly taking root. Imagine the narrow stone streets of 14th century Genoa, crowded with merchants comparing notes on which ships had sailed safely through the Strait of Gibraltar and which had never returned at all. In this atmosphere of shared gossip and shared risk, professional underwriters emerged, individuals wealthy enough to promise payment on a lost cargo, who made their living by correctly judging which voyages were safe bets and which were not. The earliest surviving marine insurance contract we know of, dated to 1347 in Genoa, covered a shipment of goods bound for the island of Majorca, protecting the merchant against the very real chance that pirates, storms, or simple misfortune might claim the vessel before it ever reached port. The tension here was deeply personal for the underwriter, who staked real money on judgment alone, with no actuarial science to soften the guesswork. Slowly, though, patterns of loss began to accumulate in merchants' memories, and out of memory, something like early expertise began to grow. Venice, Genoa's great maritime rival, developed its own sophisticated insurance markets almost in parallel, driven by the enormous scale of its trading empire across the Mediterranean and beyond. Venetian merchants insured shipments of spices from the east, wool from England, and glassware from their own famous workshops on the island of Murano, spreading risk across a web of underwriters who often insured only a small fraction of any single voyage. This practice of splitting a single insurance policy among many underwriters, each taking on a modest slice of the total risk, meant that no one person's fortune depended entirely on the fate of one ship. The tension it solved was profound. A single shipwreck could no longer bankrupt a single family, because the loss had already been quietly divided among dozens of hands before the storm ever arrived. This is what makes Venetian insurance markets so quietly remarkable. They had discovered, through sheer commercial necessity, the same wisdom about diversification that would take modern financial theory centuries to fully articulate in writing. As trade routes shifted northward toward the Atlantic in the 15th and 16th centuries, so too did the center of marine insurance, following merchants from Italy into the bustling port city of Antwerp. Antwerp's position at the mouth of the Scheldt River made it a natural meeting point for goods flowing between the Mediterranean, the Baltic, and the newly opened Atlantic trade routes toward the Americas. Insurance brokers set up offices near the city's famous bourse, where merchants, ship owners, and underwriters gathered daily to negotiate policies on everything from wool to sugar, to the earliest cargoes of silver crossing the ocean from the New World. The tension of this era was a widening one, no longer just about storms and pirates, but about the sheer unfamiliarity of these longer, stranger voyages, where no one yet had centuries of recorded experience to draw upon. Still, the underwriters of Antwerp pressed forward, patient enough to price risks that no one before them had ever had to imagine. When political and religious upheaval eventually drove much of this commercial activity out of Antwerp, it found a welcoming home in Amsterdam, which by the early 17th century had become the financial heart of the world. The Dutch East India Company, founded in 1602, needed enormous amounts of capital and enormous amounts of protection for its long, dangerous voyages to Asia, and Amsterdam's insurance markets grew rapidly to meet that need. Dutch underwriters developed increasingly formal contracts, detailed record-keeping, and even early statistical thinking about which routes and seasons carried the greatest danger, laying quiet groundwork for the mathematics that would later define the entire industry. The tension, as ever, lay in the scale of ambition, outpacing the scale of understanding. These were voyages lasting years, through seas no European underwriter had ever personally seen, insured almost entirely on faith and second-hand report. And yet Amsterdam's patient, methodical merchants kept refining their craft, sailing further into both the ocean and the unknown mathematics of risk. Across the English Channel, London was quietly building toward its own transformation into the insurance capital of the world, though few realized it yet. In the middle of the 17th century, English merchants had long relied on continental underwriters for their marine coverage, traveling to Antwerp or Amsterdam to arrange protection for their own ships, an arrangement that felt increasingly inconvenient as London's own trade grew larger and more ambitious. Slowly, London developed its own community of underwriters who gathered informally near the docks and the busy commercial streets of the city, comparing notes over shared meals and shared risk in the same way merchants had done in Genoa 3 centuries earlier. The tension of this period was simply one of trust. London's underwriters were newer to the craft, and merchants had to decide whether local promises were as reliable as the older, more established continental markets. Reputation, patiently built one honored claim at a time, would prove to be the only real currency that mattered. It was in a small coffee house on Tower Street, run by a man named Edward Lloyd, that London's future as an insurance capital quietly began to take shape. Opened around 1686, Lloyd's Coffee House became a natural gathering place for sailors, shipowners, and merchants who wanted the freshest news about which vessels had arrived safely and which had been lost at sea. Edward Lloyd, sensing an opportunity, began posting shipping news on the walls of his establishment and even publishing a regular newsletter summarizing arrivals, departures, and disasters, turning his humble coffee house into the most reliable source of maritime information in the city. Underwriters naturally gravitated toward this steady stream of information, gathering at Lloyd's tables to negotiate policies on the ships being discussed, often literally signing their names beneath the terms of a risk they were willing to accept. From that habit of signing beneath a contract, the very word underwriter was quietly born, and it has carried that gentle, literal meaning ever since. Imagine the noise and warmth of Lloyd's Coffee House on a damp London evening. Candlelight flickering over tables crowded with merchants trading rumors of storms in the Atlantic and pirates off the Barbary coast. Individual underwriters at Lloyd's, wealthy men willing to risk their personal fortunes, would each accept a small portion of a ship's total insured value, writing their name and the amount they guaranteed directly onto the policy document itself. This system meant that a single voyage might carry the signatures of a dozen or more underwriters, each one liable only for their own small share, echoing the very same wisdom the merchants of Venice had discovered centuries before. The tension of this world was intensely personal. A bad string of losses could ruin an underwriter overnight, and so reputation at Lloyd's became almost sacred, guarded more fiercely than money itself. Out of that fierce, careful culture of honor, Lloyd's would eventually grow into one of the most famous insurance institutions the world has ever known. Lloyd's gradually formalized itself over the following century, moving from its original coffee house into more official premises and eventually adopting a structured system of syndicates in the early 1800s. Rather than one wealthy individual bearing an entire risk, groups of underwriters organized themselves into syndicates that could collectively insure much larger and more complicated risks than any single person could responsibly carry alone. This structure allowed Lloyd's to insure not just ships, but eventually almost anything imaginable: famous performers' voices, film productions, satellites, and enormous industrial projects. all bound by the same old habit of spreading risk across many willing shoulders. The tension of growth was one of identity. As Lloyd's expanded far beyond its original maritime focus, it had to continually decide what kind of institution it wanted to remain, as the world around it grew ever more complex. Even today, the rhythm of individual underwriters gathering to accept small shares of large risks still echoes, quietly, back to that candlelit coffeehouse on Tower Street. Fire, that oldest fear of every crowded medieval city, finally forced London into building formal fire insurance after catastrophe struck in the most dramatic way imaginable. In September of 1666, a small fire that began in a bakery on Pudding Lane spread rapidly through London's tightly packed, timber-framed streets, eventually destroying more than 13,000 houses and leaving tens of thousands of Londoners homeless within a matter of days. The devastation was so total and so widely witnessed that it made the abstract danger of fire suddenly, viscerally real to an entire generation of city dwellers who had perhaps grown complacent about the risk. In the difficult months that followed, many families lost everything they owned, with no institution standing ready to help them rebuild. A hardship history remembers honestly, but does not need to dwell upon in gruesome detail. Out of that widespread grief, though, came real innovation, as Londoners resolved that such total, unprotected loss should never again be allowed to happen so completely unchecked. A dentist and inventor named Nicholas Barbon saw opportunity in the ashes of the Great Fire and founded what is generally regarded as the world's first true fire insurance company in 1667. Barbon's company insured homes against fire damage in exchange for a regular premium, promising to pay for rebuilding if disaster struck. A simple idea that felt almost radical to a city still recovering from catastrophic loss. Rival companies soon followed, each developing their own distinctive fire marks. Small metal plaques bolted to the front of insured buildings, allowing private fire brigades to quickly identify which homes were covered by their company and therefore worth rushing to save. The tension of this new system was an uncomfortable one, because it meant that an uninsured home, burning right beside an insured neighbor's house, might genuinely be left to burn, while brigades tended only to the properties bearing their own company's mark. Over time, this harsh incentive quietly pushed fire insurance from a luxury into something closer to a necessity for anyone who owned property at all. Imagine a London street in the early 18th century, small lead fire marks glinting above doorways, each one a quiet promise that help would come quickly if flames ever appeared. As competition between fire insurance companies grew, many of them began forming and funding their own private fire brigades, staffed with trained men and horse-drawn pumps who would race to any fire bearing their company's distinctive emblem. This arrangement, strange as it sounds today, actually improved firefighting technology and speed considerably, as companies competed not just on price, but on how quickly and effectively they could respond to a blaze. The tension eased slowly as cities began to realize that fire, unlike a single merchant's lost cargo, threatened entire neighborhoods regardless of who held which policy, and that firefighting itself might work better as a shared public good rather than a private competitive advantage. It would take many more decades, but this quiet realization eventually helped push cities toward the public fire departments we take for granted today. Fire insurance spread quickly from London to other growing cities across Europe and eventually to the American colonies, where wooden buildings and crowded streets carried the very same old danger. In Philadelphia, a young printer and civic-minded thinker named Benjamin Franklin helped organize the Philadelphia Contribution Ship in 1752, one of the first successful fire insurance companies in the American colonies, built explicitly on the model of mutual protection rather than pure profit. Members of the contribution ship paid into a shared fund and, in a distinctly Franklin touch, agreed to certain fire safety standards for their properties, since preventing fires mattered every bit as much as compensating for them after the fact. The tension facing early American insurers was one of frontier uncertainty. Without centuries of dense urban data to draw upon, they had to estimate risk in fast-growing towns whose buildings, populations, and hazards were all changing rapidly year to year. Franklin's own careful, methodical instincts, the same instincts that led him towards science and civic invention, shaped an insurance culture in America that valued prevention just as highly as protection. While fire insurance protected buildings, an even more tender question was quietly stirring across Europe: whether a person's own life and the financial well-being of the family left behind could be insured in the same practical way. Life insurance carried a heavier moral weight than marine or fire coverage, because it required people to openly discuss and financially plan around the death of someone they loved, a conversation many found deeply uncomfortable even to consider. Early attempts at life insurance in England during the 16th and 17th centuries were often little more than informal wagers, sometimes indistinguishable from simple gambling on how long a particular person might live. The tension was as much moral as it was financial, since betting on a stranger's death felt, to many observers, uncomfortably close to wishing for it. It would take real mathematical rigor, developed patiently over the following century, to transform life insurance from something resembling a wager into something resembling genuine, respectable care for a family's future. The Amicable Society for a Perpetual Assurance Office, founded in London in 1706, is widely remembered as the world's first true life insurance company, built on the honest premise of mutual benefit rather than speculation. Members paid a fixed annual contribution into a shared fund, and when a member died, their surviving family received a payout drawn from that same pooled fund, an arrangement that echoed the old Roman burial collegia across more than 1,000 years of quiet historical distance. The Amicable Society limited its membership to a manageable number of people between certain ages, an early and somewhat clumsy attempt to keep the pool of risk reasonably balanced without any real mathematical understanding of mortality yet guiding the decision. The tension facing the society was substantial, since nobody yet knew with any precision how long people of a given age were statistically likely to live, leaving early premiums closer to careful guesswork than genuine calculation. What the Amicable Society lacked in mathematical certainty, though, it made up for in the simple, steady comfort of knowing that a family would not face grief and poverty in the very same season. The mathematics that life insurance so badly needed arrived through the quiet, patient work of scientists who were, at first, simply curious about population records rather than commercial insurance at all. The astronomer Edmond Halley, better remembered today for the comet that bears his name, published a landmark study in 1693 analyzing detailed birth and death records from the city of Breslau, creating one of the very first mortality tables showing the statistical likelihood of death at each age. Halley's careful tables revealed patterns that had always existed in human populations, but had never before been laid out so plainly. That mortality followed predictable curves across a lifetime, higher in infancy, lower through the middle years, and rising again steadily with old age. The tension this discovery quietly resolved was enormous, because for the first time, insurers had genuine evidence to price life insurance fairly, rather than relying on instinct, prejudice, or simple hope. It is a strange and lovely thing, when you consider it, that an astronomer studying the patterns of the stars ended up giving families a mathematical language for planning around the patterns of their own mortality. Imagine Edmond Halley bent over ledgers of birth and burial records late into the night, tracing the quiet arithmetic of human life expectancy by candlelight in his study. Building further on this foundation, the mathematician Abraham de Moivre published his own influential work on mortality and probability in the early 18th century, refining the statistical tools that would eventually let insurers calculate premiums with genuine precision rather than rough estimation. De Moivre's formulas allowed for the calculation of the present value of a future life insurance payout, a concept that sounds technical but carries a deeply human purpose, determining, fairly and honestly, what a family's future protection was truly worth today. The tension of this mathematical revolution was a slow one to resolve in practice, since it took decades for insurance companies to actually adopt these careful calculations, rather than clinging to older, cruder methods that were simpler but far less fair. Patience, in this part of our story, belonged not to sailors or merchants, but to mathematicians, quietly working out the arithmetic of mortality long before the wider commercial world was ready to trust it. Alongside formal life insurance, an unusual financial invention called the tontine captured the imagination of 18th century Europe, blending insurance with something closer to a slow, strange lottery. Named after the Italian banker Lorenzo de Tonti, who first proposed the idea to the French government in the 1650s, a tontine allowed a group of investors to pool their money together, with the interest from that shared fund distributed only among the surviving members each year. As members of the tontine gradually died, the survivors received an ever larger share of the annual interest, until finally, the very last survivor collected the entire remaining fund, all to themselves. The tension here was uncomfortably sharp, since every participant's financial fortune was tied directly, and rather morbidly, to the deaths of the people around them, a closeness to mortality that many found unsettling even as they eagerly bought in. Tontines eventually fell out of favor as more balanced and less unsettling forms of life insurance matured, but they remain a strange, fascinating footnote in the long human effort to plan financially around the uncertainty of a lifespan. As the 18th century gave way to the 19th, and factories began reshaping the landscape of Europe and America, an entirely new category of economic risk emerged for ordinary working people. Industrial labor was dangerous in ways agricultural life had never quite been. Machinery could maim a worker in an instant, mines could collapse without warning, and mills ran at hours and speeds that left little room for caution or rest. Working families, often living paycheck to paycheck with no savings to fall back on, faced genuine catastrophe if the primary wage earner was injured, killed, or simply too sick to work for an extended stretch of time. The tension of the industrial age was stark and immediate, since the old rural safety nets of extended family, shared land, and village mutual aid did not easily translate into crowded, transient factory towns full of strangers. Into this gap, a new kind of institution quietly stepped forward, built by workers themselves rather than by wealthy underwriters or distant insurance companies. Friendly societies, sometimes called mutual aid societies, spread rapidly across working-class Britain during the 18th and 19th centuries, offering ordinary laborers a version of the same protection that guilds had once offered medieval craftsmen. Members paid small weekly or monthly dues into a shared fund and in return received support during illness, disability, or unemployment, along with a guarantee that their family would not face a pauper's burial if the worst happened. By the middle of the 19th century, millions of working people in Britain belonged to some form of friendly society, meeting in local halls, pubs, and chapels to manage their shared funds with a democratic seriousness that mirrored the governance of far wealthier institutions. The tension these societies constantly navigated was one of solvency, since an unlucky run of illness or accident among members in a single year could threaten to drain a fund faster than it could ever be replenished. This is what makes the friendly society movement so quietly moving. It proved that working people, given the chance to organize themselves, could build systems of genuine mutual care entirely from the ground up. In the United States, a similar spirit took root through fraternal organizations and mutual benefit societies, many of which emerged from immigrant communities seeking security in an unfamiliar new country. Groups such as the Odd Fellows and the Freemasons expanded their traditional social and ceremonial functions to include genuine financial protection, offering members life insurance, sick benefits, and burial coverage decades before commercial insurance companies made such products widely affordable to ordinary Americans. For immigrant families arriving with little more than hope and a willingness to work, these fraternal societies offered something commercial insurers often would not: a sense of belonging bound tightly together with practical financial protection. The tension these organizations faced was a delicate balancing act between fellowship and finance, since maintaining warm communal bonds while also managing serious actuarial responsibilities required a kind of dual discipline that not every local chapter managed equally well. Even so, for millions of working families, these societies quietly stood in the gap that neither government nor commercial industry had yet stepped forward to fill. As commercial life insurance companies grew larger and more established through the 19th century, they gradually adopted the same careful mathematical foundations that mutual societies and Lloyd's underwriters had been slowly refining for over a century. Companies like Equitable Life in London, founded in 1762, pioneered the systematic use of age-based premiums calculated from genuine mortality tables, charging younger, lower-risk members less than older members whose statistical likelihood of death was naturally higher. This shift toward genuine actuarial fairness marked a quiet turning point in the industry's maturity, moving life insurance decisively away from its earlier, cruder flat-rate systems and toward something resembling true mathematical honesty. The tension this fairness introduced was a social one, since charging people differently based on age, health, or occupation raised uncomfortable questions about who could actually afford protection and who might be quietly priced out of it altogether. These questions, in truth, have never fully disappeared from the insurance industry, echoing forward from Equitable Life's actuaries all the way into our own modern debates about fairness and access. Imagine the offices of a Victorian actuary, rows of leather-bound mortality tables stacked along the walls, a young clerk carefully calculating premiums by candlelight, and careful, patient arithmetic. The actuarial profession itself formalized during this period, with the Institute of Actuaries founded in London in 1848, establishing rigorous training, examinations, and professional standards for the mathematicians who would now underpin the entire insurance industry. These actuaries brought a discipline that was almost scientific in its patience, studying enormous data sets of birth, death, illness, and accident to refine ever more precise and fair methods of pricing risk across an entire population. The tension of this new professional class was one of trust, since ordinary policyholders had to place enormous faith in calculations they themselves could never fully understand or verify. Over time, though, the steady, careful reputation of actuaries became one of the insurance industry's quiet foundations, a profession built almost entirely on the unglamorous virtue of getting the numbers right. While life and fire insurance matured in Europe, a parallel and equally important story was unfolding in the world of shipping, as marine insurance adapted to the enormous scale of 19th century global trade. Steamships, larger and faster than the wooden sailing vessels of earlier centuries, carried cargo worth vastly more than anything Genoese or Venetian merchants could have imagined, and insurers had to develop increasingly sophisticated methods for assessing and spreading such enormous individual risks. Lloyd's of London remained at the center of this world, its syndicates now insuring entire fleets, and its network of surveyors and inspectors stretching to ports across the globe to assess ships and cargoes before a policy was ever agreed upon. The tension of this expanding scale was one of complexity, since a single steamship might carry cargo insured by dozens of different underwriters, each holding only a fractional interest but all depending on shared, accurate information about the ship's true condition. Out of this complexity grew classification societies, independent bodies that inspected and rated the seaworthiness of vessels, giving underwriters a trusted, external measure of risk they could not always judge for themselves. The classification society Lloyd's Register, formally organized in the mid-18th century and refined considerably through the 19th, inspected ships and assigned them ratings that underwriters could use to judge how much risk a particular vessel truly represented. A ship rated in the highest class was considered well-built, well-maintained, and a comparatively safe bet for insurers, while lower-rated vessels commanded higher premiums to reflect their greater likelihood of trouble at sea. This system created a powerful incentive for ship owners to properly maintain their vessels, since a poor rating meant either paying steep insurance costs or struggling to find any underwriter willing to accept the risk at all. The tension it eased was a long-standing one in maritime trade, replacing pure guesswork and personal reputation with something closer to a standardized, independently verified measure of quality. In this quiet way, insurance itself became a force for genuine safety improvement, rewarding careful shipbuilding and careful maintenance with the simple, practical currency of lower premiums. As the 19th century progressed, insurance also expanded into entirely new categories that earlier centuries had never needed to imagine, including protection against accidents, theft, and even the emerging dangers of new transportation technology. The first railway accident insurance policies appeared in Britain in the 1840s, offering passengers modest protection against injury during a form of travel that, however revolutionary, also carried genuinely new and unfamiliar risks at speeds no human body had ever experienced before. Insurers had almost no historical data to draw upon for these new dangers, forcing them to rely on careful early observation and cautious pricing, while enough claims experience slowly accumulated to support more confident calculations. The tension of insuring entirely new technologies would repeat itself again and again throughout the coming century, as insurers faced automobiles, airplanes, and eventually digital risks with the very same nervous uncertainty railway underwriters once felt about steam locomotives. Each time, though, patience and careful record-keeping eventually turned unfamiliar danger into something the industry could price with reasonable confidence. By the later decades of the 19th century, a new and much larger question was stirring across industrializing Europe: whether the state itself, rather than private companies or voluntary mutual societies, ought to guarantee basic protection for its citizens. In Germany, Chancellor Otto von Bismarck, driven partly by genuine social concern and partly by a shrewd desire to undercut the appeal of socialist political movements, introduced a series of landmark social insurance laws beginning in 1883. These laws established compulsory health insurance for industrial workers, followed soon after by accident insurance, and then, in 1889, old age and disability insurance, creating what many historians consider the first modern welfare state, built explicitly around the principle of social insurance. The tension behind Bismarck's reforms was deeply political as much as economic, since mandatory contributions from both workers and employers represented a genuinely new relationship between the state and the financial security of its citizens. Whatever Bismarck's private motives may have been, the system he built quietly proved something important: that insurance, once purely a private commercial matter, could also become a shared civic promise woven directly into the structure of a nation. Imagine a German factory worker in the 1880s receiving, for the very first time, a small government-issued booklet confirming that a portion of his wages was now protected against illness and eventual old age. Bismarck's model spread gradually across Europe in the decades that followed, influencing similar social insurance schemes in Austria, Britain, and eventually much of the industrialized world, each nation adapting the basic principle to its own political and economic circumstances. Britain introduced its own National Insurance Act in 1911, providing unemployment and health insurance to millions of workers through a system of compulsory contributions from employees, employers, and the government itself. The tension of these early welfare systems was never fully resolved, and arguably never will be, since every generation must renegotiate exactly how much risk belongs to the individual, how much to the employer, and how much to society as a whole. Still, the basic architecture Bismarck first assembled in the 1880s remains recognizable in social insurance systems around the world even today. A quiet, sturdy inheritance from one chancellor's pragmatic response to the anxieties of his era. In the United States, the path towards social insurance took a slower and more hesitant course, shaped heavily by the nation's stronger cultural emphasis on private enterprise and individual self-reliance. Private commercial life and accident insurance grew enormously through the late 19th century, with companies like Metropolitan Life and Prudential building vast sales forces that brought affordable policies directly to working-class families through door-to-door agents and small weekly premium collections. These industrial life insurance policies, often covering just enough to pay for a modest funeral, became remarkably popular among immigrant and working-class communities who had few other ways to guard against the shame and hardship of an unmarked, unpaid-for burial. The tension of this industry was an uncomfortable one, since agents were sometimes paid on commission that encouraged them to sell policies to families who could barely afford the weekly premiums, occasionally trading long-term financial strain for short-term peace of mind. Even so, for many families living on the very edge of poverty, these small policies represented one of the only forms of financial dignity available to them. It would take the devastating shock of the Great Depression to finally push the United States toward a broader, government-backed system of social insurance, born out of hardship so widespread it touched nearly every American household. The stock market crash of 1929 and the years of economic collapse that followed left millions of Americans without jobs, without savings, and often without any real safety net beyond the strained generosity of family, church, and local charity. In this atmosphere of genuine national crisis, President Franklin Roosevelt signed the Social Security Act in 1935, establishing a compulsory federal program providing retirement income and unemployment insurance, funded through payroll contributions from workers and employers alike. The tension surrounding Social Security was fierce, even at its founding, with fervent debate about the proper size and reach of government, debate that in many ways has never fully quieted in the decades since. What is easy to forget, looking back from a comfortable historical distance, is simply how frightened an entire generation had become, and how deeply that fear shaped the shared insurance systems we now so often take for granted. As the 20th century advanced, the insurance industry itself grew increasingly aware that even its largest individual companies could face catastrophic losses beyond what any single insurer could safely absorb alone, giving rise to the practice of reinsurance. Reinsurance is, in its essence, insurance for insurance companies themselves, a way for one insurer to pass along a portion of its own risk to another company, spreading enormous potential losses, such as those from a major earthquake or hurricane, across an even wider pool of shared capital. The Cologne Reinsurance Company, founded in Germany in 1846, is often credited as the world's first company dedicated purely to this specialized form of protection, quietly insuring the insurers who themselves insured ordinary policyholders. The tension reinsurance addressed was a structural one, buried deep in the logic of the industry itself, since even the most careful insurer could, in a single catastrophic event, face more claims than its reserves could ever comfortably cover. In this way, reinsurance became a kind of hidden final layer of the whole insurance system, a quiet safety net stretched invisibly beneath all the other safety nets we have already walked through together tonight. Catastrophic natural disasters throughout the 20th century repeatedly tested and ultimately strengthened the growing web of reinsurance connecting insurers across the globe. The devastating San Francisco earthquake and fire of 1906 destroyed a significant portion of the city and generated insurance claims so enormous that several smaller insurance companies were pushed to the very edge of solvency, unable to pay what they had promised. Lloyd's of London, notably, earned lasting international respect during this crisis by paying its San Francisco claims promptly and in full, even when doing so caused genuine financial strain, reinforcing a reputation for honoring commitments that had been carefully built over more than 2 centuries. The tension of catastrophic events like this one never fully disappears from the insurance industry, since every large disaster forces a fresh, difficult reckoning between what has been promised and what can actually be paid. Reinsurance networks, strengthened by hard lessons like San Francisco, gradually became robust enough to absorb even the largest disasters without collapsing the underlying promise that insurance depends upon. Imagine underwriters at Lloyd's in 1906 reading telegraph reports of San Francisco in flames, calculating losses that dwarfed anything most of them had ever personally handled before. Their decision to pay claims quickly and without excuse, even amid genuine uncertainty about the company's own finances, became a defining moment in the culture of the entire institution, still referenced with quiet pride by underwriters generations later. This is what makes the history of insurance so quietly haunting at times. Behind every calm actuarial table lies a real human promise, tested most severely in exactly the moments when keeping that promise is hardest. The tension between mathematical caution and moral obligation runs through nearly every chapter of this story. From Roman burial societies to modern reinsurance treaties spanning entire continents, it is, in many ways, the same tension that first appeared beside the ancient rivers of Babylon, simply dressed now in newer, more complicated financial language. Automobiles brought an entirely new category of risk into the 20th century, one that combined personal injury, property damage, and legal liability in ways earlier forms of insurance had never quite needed to address together. As car ownership expanded rapidly through the early decades of the century, insurers developed new policies covering collision damage, medical costs, and liability toward other drivers or pedestrians who might be injured. A genuinely novel bundling of risks under a single, evolving product. Many governments eventually made a certain minimum level of automobile liability insurance legally mandatory, recognizing that the freedom to drive carried real potential to harm others in ways society had a legitimate interest in protecting against. The tension surrounding mandatory auto insurance persists even now, balancing an individual's freedom and privacy against a broader collective interest in ensuring that victims of accidents are not left financially stranded by another person's mistake. It is, in its own modern way, simply a fresh variation on the very oldest insurance question of all. How much of another person's misfortune should the rest of us quietly agree to help carry? Health insurance followed its own distinct and often more difficult path through the 20th century, shaped heavily by the different political choices various nations made about how medical care itself ought to be organized and paid for. In Britain, the National Health Service, established in 1948 in the difficult, hopeful years following the Second World War, effectively nationalized health insurance and health care delivery together, funded through general taxation and offered freely to all citizens at the point of use. In the United States, by contrast, health insurance developed largely through private employers who began offering coverage as an employee benefit during the wage controls of the Second World War, gradually building a system quite different from the more centralized European models. The tension between these different national paths remains genuinely unresolved even today, with each system offering its own particular strengths and its own particular struggles around cost, access, and fairness. Whatever path any single nation eventually chose, though, the underlying human need beneath all of it stayed exactly the same as it had always been: the fear of facing illness without any way to pay for its cure. Imagine a British family in the years just after the Second World War, still recovering from wartime hardship, visiting a doctor for the very first time without worrying about the cost of the appointment itself. The founding of the National Health Service represented, for many ordinary citizens, an almost unimaginable shift in how vulnerability itself was handled by a modern society, moving the weight of medical risk from individual families onto the shoulders of the entire nation together. Aneurin Bevan, the government minister most closely associated with the NHS, described its founding purpose in terms of shared national dignity, an idea that echoed, whether he knew it or not, all the way back to the collegia of ancient Rome, caring for their poorest members' burials. The tension of funding such an ambitious system never fully disappeared, requiring difficult ongoing choices about taxation, priorities and the genuine limits of what any collective system can realistically promise. Even amid those difficult choices, though, the basic insurance instinct, spreading one family's misfortune across the resources of the wider group, had simply grown over thousands of years from a small merchant's contract into the founding principle of an entire nation's healthcare. The later 20th century brought insurance into realms that would have seemed like pure fantasy to the merchants of ancient Babylon or even the underwriters of Victorian London. Companies began insuring against remarkably specific and unusual risks: a famous performer's singing voice, a professional athlete's legs, the successful completion of a film production, or the safe launch of a satellite into orbit, each representing enormous financial value tied to a single, fragile point of possible failure. Lloyd's of London, true to its centuries-old tradition of accepting unusual and highly specialized risks, remained at the center of many of these novel policies, its underwriters continuing the same essential craft their coffeehouse predecessors had practiced 3 centuries earlier. The tension of ensuring something so specific and unprecedented lay in the near-total absence of historical data, forcing underwriters back toward the careful, patient judgment that had guided the very earliest insurers long before actuarial science existed at all. In this curious way, the most modern and unusual insurance policies of the 20th century circled back, almost poetically, to the same instinctive judgment that had guided merchants in 14th century Genoa. Space itself, once purely the territory of governments and their vast national budgets, gradually became an insurable risk as commercial satellite launches grew more common through the final decades of the 20th century. Insurers began covering the enormous cost of building and launching satellites, accepting genuinely staggering potential losses if a rocket failed during launch or a satellite malfunctioned once it reached orbit, risks that could easily run into hundreds of millions of dollars for a single mission. Because so few launches had ever occurred, early space insurance underwriters faced almost the same blind uncertainty that had once faced Dutch merchants insuring the earliest voyages to distant Asia, guessing carefully at odds nobody could yet calculate with real confidence. The tension of space insurance captured, in a strange and rather beautiful way, the entire arc of our story tonight. Humanity's oldest instinct for sharing risk, stretched now all the way from ancient river valleys into the vacuum above the atmosphere itself. It is a quiet reminder that no matter how far human ambition travels, the basic need to soften uncertainty with shared protection seems to travel right alongside it. Insurance against natural catastrophe grew increasingly sophisticated through the later 20th century, as insurers developed detailed statistical models predicting the likelihood and cost of hurricanes, earthquakes, floods, and other large-scale disasters across entire regions. Catastrophe modeling, drawing on advances in computing power and meteorological science, allowed insurers to estimate potential losses from disasters that had not yet happened, using historical patterns, geological surveys, and increasingly detailed simulations to price risk with far greater precision than earlier generations could ever have imagined. Major disasters, such as Hurricane Andrew's devastating strike on Florida in 1992, tested these new models severely, revealing gaps in earlier assumptions and pushing the entire industry toward even more careful, humble approaches to estimating the true scale of possible catastrophe. The tension of catastrophe modeling remains an ongoing, unresolved one, since nature has a persistent and humbling habit of exceeding even the most careful mathematical predictions built to anticipate it. Even the most advanced modern insurer, with satellites and supercomputers at their disposal, is still practicing a very old and very human craft, trying, patiently and imperfectly, to plan for a future that refuses to be fully known in advance. Government-backed insurance systems also expanded considerably through the 20th century, stepping in to cover certain risks that private markets found difficult or unprofitable to insure entirely on their own. In the United States, the National Flood Insurance Program was established in 1968 after private insurers largely withdrew from flood coverage, finding the risk too concentrated and unpredictable in flood-prone areas to price profitably through ordinary commercial methods. Deposit insurance, too, emerged from the hard lessons of the Great Depression, with the Federal Deposit Insurance Corporation, founded in 1933, to guarantee that ordinary bank customers would not lose their savings if their bank failed, a protection that helped quietly restore public trust in the entire banking system. The tension behind these government programs was a practical one, recognizing that certain risks were simply too widespread, too correlated, or too politically important to leave entirely to private markets and their understandable caution. In each case, government stepped gently into the same old role that Roman collegia and medieval guilds had once played for their own members, simply on a scale those ancient institutions could never have imagined. Imagine a small-town American bank in 1933, a hand-painted sign freshly placed in its window announcing federal deposit insurance for the very first time, quietly calming a community still shaken by years of bank failures. This single reassurance that ordinary savings were now protected regardless of what happened to any individual bank helped restore a kind of collective calm that mere private promises alone had struggled to provide during the chaos of the preceding years. The insurance instinct, we can see clearly by this point in our story, was never really only about money at all, but about something gentler and more fundamental. The simple ability to trust that tomorrow's uncertainty will not undo everything worked for today. This is what makes the history of insurance so quietly fascinating across every century we have walked through together. The same tender human need appearing again and again in endlessly different disguises. From Babylonian caravan loans to federal deposit guarantees, the shape of the solution kept changing, but the fear it answered never really did. By the later 20th century, the insurance industry had grown into one of the largest and most complex sectors of the global economy, employing millions of people and managing trillions of dollars in pooled reserves across countless different products and markets. Large multinational insurance companies now operated across dozens of countries simultaneously, insuring everything from small family homes to enormous industrial complexes, all bound together by the same essential mathematics first sketched out by Edmond Halley in his quiet study centuries earlier. Regulatory bodies in nearly every country developed increasingly detailed rules governing how insurers managed their reserves, ensuring that companies kept enough capital on hand to genuinely honor the promises they had made to millions of policyholders. The tension of this enormous scale was one of genuine complexity, since even well-intentioned regulations struggled to keep pace with an industry innovating new products, new risks, and new markets at an ever-accelerating rate. And yet, beneath all that complexity, the industry's oldest and simplest promise remained exactly as it always had been, that many people, sharing a little risk each, could protect any one of them from carrying too much of it alone. The rise of computing technology through the final decades of the 20th century transformed how insurers gathered, analyzed, and priced risk. allowing calculations that would have taken Victorian actuaries entire careers to complete by hand. Insurance companies began building enormous databases tracking claims history, demographic patterns, and risk factors across millions of policyholders, refining their pricing with a level of precision and speed that would have seemed almost magical to the underwriters gathered at Lloyd's coffeehouse 3 centuries earlier. This new computational power allowed for increasingly personalized insurance pricing, tailoring premiums more closely to an individual policyholder's specific circumstances rather than relying purely on broad group averages as earlier generations had done. The tension of this personalization cut both ways, offering fairer prices to genuinely low-risk individuals while raising uncomfortable new questions about how much personal information any individual ought to be asked to share simply to obtain basic financial protection. Even here, in the most technologically advanced corner of our story, the same old balance quietly persisted between fairness to the individual and solidarity within the shared group. Health, life, property, and casualty insurance each continued evolving through the closing decades of the 20th century into the 21st, adapting steadily to new risks that earlier generations could never have anticipated at all. Cybersecurity insurance emerged as a genuinely new category in the final years of the 20th century, protecting businesses against the financial cost of data breaches and digital attacks, risks that simply had not existed in any meaningful sense before the widespread arrival of computer networks. Insurers found themselves once again in the uncomfortable, familiar position of pricing an unfamiliar danger with almost no historical data to guide them, echoing the very same uncertainty that once faced railway insurers assessing the risks of steam locomotives more than a century earlier. The tension of insuring genuinely new technology never really disappears from this story, simply reappearing in a fresh form with each new leap of human invention. It is, in its own quiet way, a comforting continuity, proof that the underlying craft of insurance, however modern its tools become, remains rooted in the very same patient instincts first practiced along ancient trading routes thousands of years ago. Microinsurance emerged as another quiet but meaningful innovation in the final years of the 20th century and the opening years of the 21st, extending the old promise of shared protection to some of the world's poorest communities. Designed for people earning very little, often in developing regions of Africa, Asia, and Latin America, microinsurance offered extremely small, affordable premiums, covering modest but genuinely life-altering risks: the loss of a single cow, a failed harvest, or a family's small home destroyed by flood or fire. These programs often partnered with local community organizations and mobile banking services, adapting the ancient logic of shared risk to fit circumstances that traditional commercial insurers had long overlooked as unprofitable or impractical to serve. The tension microinsurance addressed was a deeply old and deeply human one, echoing all the way back to medieval guilds and Roman collegia. The simple recognition that even people with very little to lose still deserve some gentle cushion against losing what little they have. In many ways, microinsurance represents this entire story, circling quietly back to its origins, extending humanity's oldest financial instinct to the very people who need it most, and have historically been offered it least. Imagine a small farming village in rural Kenya where a modest mobile phone-based microinsurance program now protects farmers against the total loss of their crops during a season of unpredictable drought. For a farmer whose entire livelihood depends on a single harvest, This small, affordable policy represents exactly the same fundamental comfort that a Babylonian merchant once found in an ancient bottomry loan more than 3,000 years earlier, however different the technology carrying that comfort might now appear. This is what makes the history of insurance so quietly remarkable when you step back far enough to see its full shape. The tools have changed almost beyond recognition, from clay tablets to smartphones, but the underlying human gesture has stayed exactly, tenderly the same. The tension of uncertainty, the oldest tension in this entire story, never fully disappears from human life, no matter how advanced our tools for managing it become. What insurance offers, in every century we have walked through tonight, is never really certainty itself, but something gentler and more honest. The simple promise that uncertainty, however it eventually arrives, will not have to be faced entirely alone. As we move now toward the closing chapters of our story tonight, it is worth pausing to notice how consistently this same idea has repeated itself across every era, every culture, and every technology we have wandered through together. Ancient Phoenician sailors splitting cargo across several ships, Roman burial societies pooling small monthly dues, medieval guilds rebuilding a burned workshop, coffeehouse underwriters signing their names beneath a risky voyage, actuaries calculating mortality by candlelight, and modern microinsurance protecting a farmer's single harvest all share one quiet, unbroken thread running invisibly between them. Insurance, at its deepest and most human level, has never really been about money at all, but about the simple, patient willingness of people to carry a small piece of each other's uncertainty, so that no single person ever has to carry the whole of it alone. The tension that first appeared beside the rivers of ancient Babylon, how to survive an unpredictable world without unbearable individual risk, has never fully disappeared, and likely never will, because uncertainty itself is simply part of being alive. What has changed, gently and steadily across thousands of years, is simply how many hands have learned to reach out and share that weight together. Modern reinsurance markets today connect insurers across every continent into a single, quietly interdependent web of shared global risk, meaning that a hurricane striking the Caribbean or an earthquake striking Japan can ripple gently through insurance markets thousands of miles away. This global interconnection represents, in its own vast modern way, the exact same principle the merchants of Rhodes once practiced when they agreed to share the cost of cargo thrown overboard during a single Mediterranean storm more than 2,000 years ago. The tension of this global interdependence is a genuinely modern one, since a truly catastrophic event affecting several regions simultaneously could theoretically strain even this enormous, carefully diversified web of shared protection beyond its limits. Insurers and regulators continue working, patiently and carefully, to strengthen this global system against exactly such an unlikely but not impossible scenario, refining capital requirements and diversification strategies with each passing decade. It is, in the end, simply the largest and most sophisticated version yet of an idea first sketched in the arithmetic of Babylonian traders. That shared risk, spread widely and carefully enough, becomes something almost every community can learn to bear. Insurance regulators around the world today spend enormous effort simply ensuring that companies keep enough reserves on hand to genuinely honor their promises decades into the future, a task that requires extraordinary patience and long-term thinking, rarely rewarded by short-term attention. Life insurance policies, in particular, may not be paid out for 50 or 60 years after they are first purchased, requiring insurers to invest and manage reserves across an entire human lifetime with remarkable discipline and foresight. This long, quiet patience represents one of the industry's least visible but most important virtues, a willingness to think in decades rather than quarters, in generations rather than headlines. The tension of long-term promise-keeping is one every insurer must navigate carefully, balancing the temptation of short-term profit against the sacred, steady obligation to still be standing, reliable and solvent, when a policyholder's family finally needs them most. It is a strange kind of quiet heroism when you think about it. An entire industry built around faithfully keeping promises that may not be tested for half a century or more. Even today, in an age of satellites, supercomputers, and instantaneous global communication, the underlying emotional truth of insurance remains exactly what it was for that first Babylonian merchant borrowing money against an uncertain caravan journey more than 3,000 years ago. None of us can control the weather, the health of our bodies, the safety of our homes, or the countless small accidents of fortune that shape a human life. And insurance has never claimed to offer that impossible control. What it offers instead, quietly and consistently across every century we have explored together tonight, is something gentler and perhaps more honest. The simple, steady comfort of knowing that when misfortune finally does arrive, as it eventually does for everyone, it will not have to be faced completely alone. The tension between control and uncertainty, ultimately, cannot be resolved by any mathematical table or any amount of pooled capital, no matter how carefully calculated. What can be resolved gently is the loneliness of facing that uncertainty, and that, in the end, may be insurance's truest and most lasting gift across every age we have wandered through tonight. Workers' compensation, distinct from the broader friendly societies and mutual aid funds we have already visited tonight, emerged as its own formal legal system in the early 20th century. Born from a growing discomfort with how injured factory and mine workers had traditionally been treated. Before these laws existed, an injured worker often had to sue their own employer directly to receive any compensation at all. A slow, expensive, and deeply uncertain process that left many families without support for months or years, while a case wound through the courts. Germany's own workers' compensation law, passed under Bismarck in 1884, alongside his other social insurance reforms, replaced this uncertain lawsuit system with guaranteed, automatic payments funded through employer contributions, regardless of who was technically at fault for the accident. The tension this reform quietly resolved was profound, trading the slow, adversarial uncertainty of courtroom blame for the steadier, calmer certainty of guaranteed support, even if that support was sometimes more modest than a lawsuit might eventually have won. Nation after nation gradually adopted similar systems through the following decades, each one recognizing that a wounded worker needed steady help far more urgently than they needed a long legal argument about blame. Imagine an American coal miner in the early 1900s, injured deep underground, uncertain whether his family would ever see a cent of compensation without years of costly legal battling against his own employer. Wisconsin became the first American state to pass a workers' compensation law in 1911, and other states followed quickly afterward, gradually replacing the old patchwork of lawsuits with steady, guaranteed insurance payments for workplace injuries across the country. Employers were required to carry this insurance, and in exchange for guaranteeing prompt payment to injured workers, they gained protection from unpredictable, potentially crippling lawsuits that might otherwise threaten an entire business over a single unfortunate accident. The tension of this new arrangement asked something of both sides. Workers gave up the chance at a larger lawsuit award, and employers gave up the hope of ever fully escaping responsibility, meeting instead in a calmer, steadier middle ground. This is what makes workers' compensation so quietly remarkable among all the systems we have wandered through tonight. It replaced a courtroom argument with something closer to a quiet, guaranteed promise. Marine insurance faced one of its most severe historical tests during the era of the great ocean liners, none more famous or more sobering than the sinking of the Titanic in April of 1912. The White Star Line had insured the ship itself for a substantial sum, and passengers and cargo owners carried their own separate policies, meaning that when the great liner struck an iceberg and sank in the cold North Atlantic, insurance claims poured in from every direction almost simultaneously. Lloyd's of London, true to the reputation it had built over more than 2 centuries, paid out the ship's insurance claim promptly, honoring the same tradition of swift, honest payment that had once defined its response to the San Francisco earthquake 6 years earlier. The tension of this disaster went beyond simple financial loss, touching every underwriter and policyholder with the stark, sobering reminder that no ship, however grand or modern, was ever truly beyond the reach of the sea's oldest dangers. In the quiet aftermath, maritime safety regulations tightened considerably, and insurers themselves began pushing harder for lifeboat requirements and safety inspections, insurance once again nudging an entire industry gently toward greater care. 2 devastating world wars in the 20th century placed extraordinary strain on insurance systems across the globe, testing every principle of shared risk that centuries of careful development had slowly built. Life insurers faced the agonizing question of how to handle policies on soldiers who died in combat, a risk so widespread and so tragically concentrated that ordinary actuarial assumptions about scattered, random mortality simply broke down entirely under the weight of war. Many insurers initially excluded war deaths from standard policies, unable to price such a correlated catastrophic risk through ordinary means, though public pressure and government intervention eventually pushed many companies toward covering military personnel regardless. The tension of wartime insurance touched something deeper than mathematics, forcing an entire industry to reckon honestly with the limits of what shared risk pooling can accomplish when misfortune stops being random and starts being deliberate and widespread. These difficult wartime years are remembered honestly here, without dwelling on their suffering, but they left a lasting mark on how insurers thought about catastrophic, correlated risk for the rest of the century. Aviation insurance emerged as its own careful specialty in the years following the First World War, as commercial air travel slowly grew from a daring novelty into a genuine, if still nerve-wracking, mode of everyday transportation. Early aviation underwriters faced almost total uncertainty, since airplanes were still evolving rapidly in design and reliability, and there existed almost no historical claims data to guide a fair and confident premium calculation. Lloyd's of London again proved a natural home for these unfamiliar risks, its underwriters willing to apply the same patient, careful judgment they had once used for unfamiliar ocean voyages centuries earlier, simply pointed now toward the sky instead of the sea. The tension of insuring early aviation eased only gradually, improving alongside genuine advances in aircraft design, pilot training, and airport safety, each incremental improvement slowly earning aviation lower and more confident premiums. Today, aviation remains, statistically, one of the safest forms of travel in the world, and insurance itself quietly deserves some credit for the decades of careful incentive it applied toward exactly that steady outcome. Title insurance, a distinctly American innovation developed through the middle and later decades of the 19th century to address a very particular and quietly unsettling kind of risk buried within property ownership itself. When buying land or a home, a purchaser needed assurance that the seller genuinely held clear legal title to the property, free from hidden claims, forgotten liens, or old family disputes that might surface unexpectedly years after a sale had closed. The first title insurance company, founded in Philadelphia in 1876, offered protection against exactly this hidden risk, researching a property's legal history carefully and then insuring the buyer against any undiscovered defect that might later threaten their ownership. The tension title insurance addressed was an unusually quiet one, protecting not against future accidents like fire or storm, but against past mistakes and forgotten paperwork that might otherwise resurface, uninvited, at the worst possible moment. It remains, even today, one of the gentler reminders in our story that insurance protects not only against the future's uncertainty, but sometimes against the past's forgotten, unfinished business as well. Agricultural insurance developed its own distinctive path through the 19th and 20th centuries, responding to farmers' particular vulnerability to forces entirely beyond their control: drought, flood, hail, and blight, each capable of destroying an entire season's income in a single unlucky afternoon. Early crop insurance programs in the United States struggled badly through the early 20th century, since agricultural risk tends to affect entire regions simultaneously, making it difficult to spread evenly across a broad and genuinely diversified pool of policyholders. The federal government eventually stepped in more directly, establishing the Federal Crop Insurance Corporation in 1938 during the difficult recovery years following the Dust Bowl, subsidizing premiums to keep this essential protection affordable and available to struggling farm families. The tension of agricultural insurance never fully disappeared, since weather itself refuses to respect the tidy mathematics of diversified risk pooling, often striking an entire county or region all at once, rather than scattering its damage evenly and randomly. Even so, this steady government support helped preserve countless family farms through difficult seasons, echoing, once again, the old instinct of a wider community choosing to help carry one farmer's particular misfortune. Credit insurance quietly emerged during the industrial era as businesses increasingly extended goods and services to customers on credit rather than requiring immediate payment, creating a new and somewhat delicate category of financial risk. A manufacturer shipping goods to a distant retailer, trusting payment to arrive weeks or months later, faced genuine uncertainty about whether that retailer's own business might fail before the debt was ever settled. A risk credit insurance was specifically designed to soften. The first dedicated credit insurance companies appeared in Europe during the late 19th century, studying the financial health of borrowers, much as marine underwriters had once studied the seaworthiness of ships, gradually building expertise in judging which businesses were likely to remain solvent. The tension of credit insurance was a delicate one of trust layered upon trust, since insurers had to judge not just a single risk, but an entire web of business relationships stretching across suppliers, retailers, and customers all at once. In its own quiet commercial way, credit insurance helped keep the wheels of industrial trade turning steadily, allowing businesses to extend trust to one another with a little less fear of sudden, ruinous loss. Professional liability insurance, sometimes called malpractice insurance, developed through the 19th and 20th centuries as certain professions, physicians, lawyers, architects, and eventually many others, recognized their own particular vulnerability to honest mistakes made in service of others. A single misdiagnosed illness, a poorly drafted legal contract, or a structurally flawed building design could expose a well-meaning professional to devastating financial consequences, even when no genuine malice or extreme carelessness was ever truly involved. Physicians in particular began purchasing malpractice coverage in growing numbers through the later 19th century, as medical practice grew more complex and legal systems grew more willing to hold professionals financially accountable for genuine errors. The tension of professional liability insurance touches something gentler than pure finance, acknowledging quietly that even careful, well-trained people are still capable of human error, and that such error should not automatically mean total personal ruin. This is what makes professional liability coverage so quietly humane among all the products in our story tonight. It extends a measure of grace toward honest mistake, rather than demanding flawless perfection from every single person who serves others for a living. Nuclear energy, emerging as a genuinely new industrial force in the middle of the 20th century, presented insurers with a risk so enormous and so unfamiliar that no single company could reasonably absorb it alone. The catastrophic potential of a nuclear accident, though statistically rare, carried consequences so severe and so far-reaching that ordinary insurance pooling struggled to accommodate it within any single insurer's available capital. In response, insurers across several countries formed specialized nuclear insurance pools during the 1950s, combining the resources of many companies together specifically to cover this singular, unusually concentrated category of risk. The tension of nuclear insurance echoed, in a much larger and more consequential form, the very same challenge that had once faced Rhodian sailors sharing the cost of jettisoned cargo, a risk simply too large and too catastrophic for any one party to bear entirely alone. These pooled arrangements, still operating quietly today, represent one of the clearest modern echoes of insurance's oldest and simplest wisdom, that some burdens can only ever be carried together. Business interruption insurance developed steadily through the 20th century, addressing a quieter but often devastating consequence of disaster that simple property insurance had always overlooked: the lost income a business suffers while it struggles to rebuild after a fire, flood, or other calamity. A shopkeeper whose store burned down might eventually receive enough insurance money to rebuild the physical building, and yet still face months of lost income during reconstruction, with employees unpaid, suppliers unsettled, and customers drifting quietly toward competitors in the meantime. Business interruption policies, growing more common through the middle decades of the 20th century, covered exactly this gap, replacing lost profits during the recovery period so that a rebuilt business had a genuine chance of surviving its own reconstruction. The tension of business interruption coverage lay in calculating something inherently uncertain: what a business would have earned had disaster never struck at all, requiring underwriters to estimate not just physical loss, but an entire imagined, undisrupted future. It is, in its own way, one of insurance's gentler and more imaginative achievements, protecting not just what a business owns, but the quiet, ongoing rhythm of its everyday life. The terrorist attacks of September 2001 struck the insurance industry with a force few had ever anticipated, generating losses so enormous and so unprecedented that many insurers found their existing catastrophe models entirely unequipped to have foreseen them. Property, life, aviation, and business interruption claims arrived from a single event on a scale that forced the entire global reinsurance market to fundamentally reconsider how it priced and pooled the risk of large-scale, deliberate catastrophe. In the difficult months that followed, many insurers withdrew entirely from covering terrorism risk, unable to price something so unpredictable, until governments in several countries stepped in to create backstop programs sharing this extraordinary risk between private insurers and the state itself. The tension of insuring against deliberate human violence, rather than the accidents of nature or simple misfortune, touches something the earliest insurance pioneers rarely had to fully confront, and the industry is honest, even now, about how imperfectly it can ever truly price such intentional harm. Even so, insurers and governments together quietly rebuilt a framework for sharing this risk, echoing once again the old, patient insistence that even the darkest uncertainties are easier carried together than alone. Health insurance in the United States underwent another significant transformation in the early 21st century, with the passage of the Affordable Care Act in 2010, expanding coverage and reshaping the private insurance marketplace in ways still felt today. The law required most Americans to carry some form of health insurance, expanded government subsidies to help lower-income families afford private coverage, and prohibited insurers from denying coverage to people with pre-existing medical conditions, a protection many families had long needed but never quite had. Supporters and critics debated the law fiercely, echoing the very same tensions that had surrounded Bismarck's social insurance reforms more than a century earlier, about how much responsibility belongs to the individual and how much belongs to the wider collective society. The tension of American health insurance reform has never fully settled, with each new political era revisiting and reshaping the balance between private markets and public guarantee in its own particular way. Whatever shape the debate takes in any given decade, the underlying question remains exactly the one Bismarck's German workers first quietly faced in the 1880s: how a society decides to share the simple, universal risk of getting sick. Imagine a family sitting at their kitchen table in the early 21st century, carefully comparing health insurance plans on a laptop screen, weighing premiums and deductibles the way a Genoese merchant once weighed the odds of a dangerous winter crossing. The tools have changed almost beyond recognition across the centuries we have traveled tonight, moving from clay tablets and handwritten ledgers to spreadsheets and online marketplaces. Yet the underlying human calculation feels strikingly familiar across all that distance. Every generation, it seems, must sit down in its own way and quietly weigh the cost of protection today against the uncertain cost of misfortune tomorrow, a calculation as old as the very first Babylonian caravan loan. The tension of that calculation never fully resolves, because certainty about the future has never truly been available to any generation, however sophisticated its tools eventually become. What each generation can offer the next, though, is a steadily improving, steadily fairer set of tools for making that ancient, unavoidable calculation just a little more bearable. Pet insurance, a distinctly modern and rather tender addition to our story, emerged gradually through the later 20th century as companion animals came to occupy an increasingly central place within many families' emotional lives. The first pet insurance policy is often traced to Sweden in 1924, though the product remained a modest niche for many decades before growing rapidly in popularity across Europe, North America, and beyond toward the end of the 20th century. These policies cover veterinary costs for illness, injury, and sometimes even routine care, easing the difficult and often heartbreaking choices families once had to make when a beloved animal's medical needs exceeded what they could immediately afford. The tension pet insurance addresses is a tender one, softening the awful moment when love for an animal collides directly with the hard limits of a household budget. It is, in its own gentle modern way, simply another small chapter in humanity's very long habit of finding ways to soften hard choices with a little shared, prepared-for protection. Index-based and parametric insurance emerged in the final years of the 20th century and grew considerably through the early 21st, offering a genuinely different approach to paying out claims than almost anything that came before it in our story. Rather than requiring a lengthy assessment of actual damage after a disaster, as traditional insurance always had, parametric policies instead pay out automatically once a specific measurable trigger occurs: a certain rainfall threshold, a specific earthquake magnitude, or a defined wind speed recorded by independent weather instruments. This approach proved especially valuable in developing regions with limited infrastructure for traditional claims assessment, allowing farmers or communities to receive payment within days of a drought or storm, rather than waiting months for adjusters to complete a full, careful damage survey. The tension of parametric insurance lies in its own useful simplicity, since payments are based on a measurable trigger rather than actual loss, meaning some policyholders occasionally receive slightly more or slightly less than their true damage, a trade-off accepted in exchange for genuine speed. It represents, in its own modern, technological way, a return to something wonderfully simple at the heart of our very oldest examples tonight. A clear, agreed-upon rule, honored quickly and without excessive argument. Climate change introduced. Through the final decades of the 20th century and accelerating steadily into the 21st, one of the most significant long-term challenges the insurance industry has ever quietly faced. Rising sea levels, more frequent and more severe storms, and shifting agricultural patterns began steadily altering the underlying assumptions that decades of careful historical data had once confidently supported, forcing insurers to reconsider risks in coastal cities, farming regions, and wildfire-prone areas across the globe. Some insurers began withdrawing entirely from certain high-risk coastal or wildfire-prone regions, unable to responsibly price a risk that seemed to be growing less predictable and more severe with each passing decade. The tension of climate-related insurance risk remains genuinely unresolved even today. A slow, difficult negotiation between insurers, governments, and communities about who ultimately bears the cost of a changing climate's mounting uncertainty. It is, in many ways, simply the newest and largest chapter of the very oldest question in our story tonight: how a community decides, together and honestly, to share a risk that has grown too large for any single household to face alone. Insurtech, a term that emerged only in the past decade or so, describes a wave of new technology companies applying artificial intelligence, mobile applications, and vast new streams of digital data to the very old craft of pricing and selling insurance. These companies process claims in minutes rather than weeks, use satellite imagery and smartphone sensors to assess risk with remarkable new precision, and offer flexible, on-demand coverage that can be switched on and off for a single trip, a single event, or a single unusual need. Despite this dazzling new technology, insurtech companies are, at their core, simply applying faster, more modern tools to the exact same ancient question that has run through every century of our story tonight. how to fairly price an uncertain future and spread its risk gently across many willing shoulders. The tension of this rapid technological change lies in balancing genuine innovation against the careful, patient regulation the industry has spent centuries building to protect ordinary policyholders from being harmed by untested new methods. Even the newest, most futuristic insurance company, in other words, is still quietly practicing the same old craft that began beside the rivers of ancient Babylon more than 3,000 years ago. Directors' and officers' liability insurance, often shortened simply to D&O coverage, grew steadily in importance through the later 20th century as corporate leaders faced increasing legal exposure for decisions made on behalf of the companies and shareholders they served. A single business decision made in good faith but later criticized by shareholders, regulators, or the courts could expose an individual executive to devastating personal financial liability, a risk that grew more pronounced as corporate law itself grew more complex through the 20th century. D&O insurance emerged to protect these individuals, allowing capable people to accept leadership roles and make difficult, good-faith decisions without constantly fearing that an honest mistake might personally bankrupt them. The tension of this coverage echoes the same gentle grace we saw earlier in professional liability insurance, extending a measure of protection to people making difficult judgment calls under genuine uncertainty, rather than demanding an impossible standard of flawless foresight. It is, in its own boardroom setting, simply another quiet variation on insurance's oldest and most consistent theme, protecting good faith effort from the harshest possible consequences of an uncertain and unpredictable world. Imagine a modern corporate boardroom, executives reviewing a difficult decision under real uncertainty, quietly reassured by the knowledge that a good faith mistake will not cost them their family's entire financial security. This same quiet reassurance, in one form or another, has run beneath nearly every institution we have visited across our story tonight. From the ancient Babylonian merchant to the modern startup founder navigating unfamiliar risk, insurance, at its very core, has always been less about eliminating uncertainty and more about making that uncertainty survivable, softening the sharp edges of misfortune just enough that people can still take reasonable risks, build businesses, raise families, and sail toward the horizon without being paralyzed by fear of what might go wrong. The tension between courage and caution runs through every century we have wandered together tonight, and insurance has always occupied the quiet space between them, neither eliminating risk nor demanding recklessness, simply making the space between the two a little more bearable. It is, perhaps, the oldest and gentlest gift any economic institution in human history has ever quietly offered. As the 21st century continues to unfold, insurance faces genuinely new frontiers that would have seemed like pure imagination to even the most forward-thinking underwriters of earlier centuries. Coverage for autonomous vehicles, artificial intelligence liability, and risks tied to entirely digital and virtual assets. Self-driving cars raise unfamiliar new questions about liability, since responsibility for an accident may now rest with a software system rather than a human driver, forcing insurers to rethink assumptions about fault and responsibility that have held steady since the earliest days of automobile insurance. Artificial intelligence systems making important decisions in medicine, finance, and countless other fields raise similarly unfamiliar questions about who bears responsibility when an algorithm, rather than a person, makes a costly and consequential mistake. The tension of these new frontiers feels, in many ways, remarkably familiar to anyone who has followed our story from its beginning tonight. genuinely new technology outpacing the industry's historical data, forcing careful, patient underwriters back toward cautious judgment, while enough real experience slowly accumulates. Whatever strange and unfamiliar new risks the coming century eventually brings, the industry's oldest and steadiest habit, patient observation, careful pricing, and the quiet sharing of uncertainty among many willing hands, will very likely remain exactly as useful as it has always been. Insurance cooperatives and mutual companies, structures we first glimpsed in the friendly societies of 19th century Britain, continue quietly operating alongside larger commercial insurers even today, owned not by outside shareholders, but by their own policyholders. In a mutual insurance company, profits are returned to policyholders themselves rather than to external investors, preserving, even in our modern, highly technical financial world, something of the same democratic, member-owned spirit that once defined medieval guilds and Roman burial societies. Millions of people around the world today still hold policies with mutual insurers, often without realizing they are participating in a corporate structure with roots stretching back many centuries, long before the word shareholder carried any meaning at all. The tension between mutual and commercial insurance models persists quietly into the present day, each offering different advantages around governance, profit distribution, and long-term member loyalty. This is what makes the survival of mutual insurance so quietly moving to consider. A structure born from medieval mutual aid has managed to persist, almost entirely unbroken, into the extraordinarily different economic world of the 21st century. Government-backed export credit insurance, a somewhat technical but historically important development of the 20th century, protected exporters against the risk that foreign buyers might fail to pay for goods shipped across international borders. As global trade expanded dramatically through the 20th century, businesses increasingly needed confidence that shipping valuable goods to distant, unfamiliar markets would not end in an unpaid invoice and a devastating financial loss. Export credit agencies, often backed by national governments, extended this protection specifically to encourage international trade, absorbing risks that private insurers alone often found too unfamiliar or too politically complicated to price on their own. The tension of export credit insurance echoed across an ocean of centuries, the very same uncertainty that once faced Phoenician traders sending cargo to distant, unfamiliar ports with no guarantee of safe and honest arrival. In this quiet way, governments themselves became insurers of a kind, extending the oldest trading instinct in our story into the complicated, interconnected economics of the modern global marketplace. Insurance against political risk, a specialized and often quietly overlooked category of coverage, developed through the 20th century to protect businesses operating in politically unstable regions against losses caused by war, revolution, expropriation, or sudden changes in government policy. A company building a factory in an unfamiliar foreign country faced not just the ordinary risks of fire or accident, but the deeper uncertainty of political upheaval entirely beyond any engineer's or actuary's ability to predict or control. Specialized insurers and government-backed agencies gradually developed careful methods for pricing and pooling this unusual risk, drawing on political analysis and historical precedent in ways that echoed, in spirit, the old Genoese underwriters weighing the safety of a particular sea route centuries earlier. The tension of political risk insurance touches something larger than pure economics, acknowledging quietly that human institutions themselves, not just nature or accident, can be sources of genuine and unpredictable uncertainty. Even here, in one of the more unusual corners of our story tonight, the same old comfort applies, that even the strangest and most unpredictable risks become a little more bearable once they are carefully, patiently shared. Insurance education and consumer protection matured considerably through the later 20th century, as regulators in many countries recognized that ordinary policyholders often struggled to fully understand the complex contracts they were signing. Plain language requirements, standardized policy forms, and dedicated consumer protection agencies gradually emerged to help ordinary families compare policies fairly and understand exactly what protection they were actually purchasing. This slow, steady push toward transparency echoed a tension present all the way back in ancient Babylon, where an ordinary merchant had to trust a lender's calculations without any real way to independently verify their fairness. The tension between complexity and clarity has never fully disappeared from the insurance industry, since genuine fairness often requires detailed calculation, while genuine trust requires that ordinary people can actually understand what they are agreeing to. Slowly, patiently, industry and regulators together have worked to narrow that old gap, making the ancient promise of shared protection a little easier for ordinary families to understand and trust. Imagine an insurance regulator in the late 20th century, quietly reviewing policy documents line by line, working to ensure the language inside them could be understood by an ordinary family, rather than only by trained underwriters and lawyers. This unglamorous, careful work rarely receives much attention in the broader story of economic history, and yet it represents one of the quiet, steady ways that trust between insurer and policyholder has been carefully maintained across the many transformations we have traced tonight. Trust, after all, has been the true undercurrent running beneath every single institution in our story. The ancient merchant trusting a lender's calculation, the guild member trusting a shared fund, the coffeehouse patron trusting an underwriter's signature, the modern family trusting a printed policy document. The tension of trust never fully resolves in any economic system, requiring constant, patient renewal with each new generation and each new form the old promise happens to take. And so, gently, across 3,000 years, that renewal has simply continued, one careful contract and one honored claim at a time. The global insurance industry today manages an almost unimaginable scale of pooled protection, with trillions of dollars in reserves standing quietly ready across the world to honor promises made to hundreds of millions of policyholders. Behind every modern insurance company's balance sheet lies the same simple arithmetic that Edmond Halley first sketched from Breslau's mortality records more than 3 centuries ago, simply extended now across almost every conceivable form of human risk imaginable. From a farmer's single cow in rural Kenya to a satellite orbiting the Earth, from a family's modest life insurance policy to a multinational corporation's enormous liability coverage, the same ancient principle continues quietly operating beneath the surface of modern economic life. The tension between individual vulnerability and collective strength, the very tension that first stirred merchants beside the rivers of ancient Babylon, remains exactly as present today as it was 3,000 years ago, however differently dressed in modern financial language. And so tonight's story, though it has wandered across so many centuries and so many different cultures, ultimately returns to exactly where it began, a simple, patient human instinct to share uncertainty, so that no one has to carry it entirely alone. Islamic takaful insurance developed as a distinct tradition rooted in principles of mutual cooperation, offering a model of shared protection built specifically to align with religious guidance against interest-based lending and excessive uncertainty in financial contracts. Under Takaful, participants contribute to a shared fund with the explicit intention of helping one another in times of loss, and any surplus remaining in the fund is often returned to participants rather than kept as company profit, echoing the cooperative spirit of the very earliest mutual societies in our story tonight. Modern Takaful providers, operating across the Middle East, Southeast Asia, and beyond, have grown substantially since the concept was formally revived in the later 20th century, offering an alternative model that many families find both practically useful and spiritually aligned with their values. The tension Takaful navigates carefully is a delicate one, balancing genuine religious principle against the practical mathematical realities of pooling and pricing risk across a large and diverse group of participants. In its own distinct cultural form, Takaful reminds us that the instinct toward shared protection has never belonged to any single civilization alone, but has quietly emerged again and again wherever people have gathered together to care for one another. The legal concept of insurable interest, though rarely discussed outside insurance law itself, quietly shaped the entire industry's development by requiring that a person could only insure something they genuinely stood to lose. Early English courts, troubled by cases where strangers took out life insurance policies on people they barely knew, gradually established that a policyholder needed a real, demonstrable financial or emotional stake in whatever they were insuring, whether a ship, a building, or another person's life. The Life Assurance Act of 1774 in Britain formally codified this principle, requiring genuine insurable interest and helping distinguish legitimate insurance from the uncomfortable gambling-like wagers that had troubled the earliest life insurance markets we visited earlier tonight. The tension this law addressed was a genuinely moral one, protecting against the unsettling possibility that insurance might quietly incentivize harm, rather than simply cushioning against misfortune that would have happened regardless. This careful legal boundary, drawn nearly 250 years ago, still quietly underlies almost every insurance contract written anywhere in the world today. Annuities, a close cousin to life insurance, developed alongside it through the 18th and 19th centuries, addressing a different but related fear. Not the fear of dying too soon, but the quieter, more modern fear of living longer than one's savings might comfortably last. An annuity allows a person to exchange a lump sum of money for a guaranteed stream of regular income for the rest of their life, transferring what actuaries call longevity risk from the individual onto the shoulders of the insurance company itself. Insurers offering annuities essentially bet that, across a large enough pool of customers, some would live shorter lives and some considerably longer, allowing the steady payments to balance out fairly across the whole group, much as Halley's mortality tables had first made possible for ordinary life insurance. The tension of annuities is a strangely comforting one, since it requires an insurer to genuinely hope that its customers live long, full lives. A rare case in financial history where the institution's interest and the individual's deepest wish point gently in exactly the same direction. It is, in its own quiet way, one of the gentlest financial products in our entire story tonight, built around nothing more complicated than the wish for a long, steady life. Disability insurance developed through the 19th and 20th centuries to address a risk that life insurance alone could never quite cover, the possibility of surviving an illness or accident, but losing the ability to earn a living afterward. For a working family, a serious injury that prevented a breadwinner from returning to work could be, in some ways, even more financially devastating than death itself, since ongoing living expenses continued while income simply stopped. Disability insurance policies, growing steadily more common through the 20th century, replaced a portion of lost income during such periods, allowing families to keep their homes and their stability, while a slow recovery, if one was possible, quietly continued. The tension disability insurers faced was one of genuine difficulty in assessment, since determining the true severity and duration of an invisible or partial disability required far more careful, individualized judgment than a simple death certificate ever could. Even so, this quiet form of protection filled a gap that had been present in family financial planning since the very earliest days of industrial labor, offering steadiness precisely in the moments when steadiness felt hardest to find. Self-insurance and captive insurance companies emerged through the 20th century as an alternative path for large organizations confident enough in their own risk management to essentially insure themselves rather than purchasing coverage from an outside company. A captive insurer is typically a subsidiary created by a large corporation specifically to insure that corporation's own risks, allowing the parent company to retain more control over its premiums, claims handling, and long-term risk strategy than a traditional outside policy would ordinarily allow. This approach worked best for large, financially stable organizations with predictable, well-understood risks, essentially applying the ancient logic of risk pooling entirely within a single, sufficiently large and diversified organization. The tension of self-insurance echoes an old truth from the very beginning of our story tonight, that risk sharing becomes genuinely effective only once a group is large and diverse enough to make its own losses statistically predictable, a threshold only the largest organizations could comfortably meet entirely on their own. For everyone else, smaller businesses and ordinary families alike, the older and gentler solution remained exactly the same as it had always been, joining together with many others rather than standing entirely alone. Catastrophe bonds emerged in the final years of the 20th century as an innovative way to bring the enormous resources of global financial markets directly into the business of sharing extreme, low-probability disaster risk. These instruments allow insurers to transfer a portion of catastrophic risk, such as a major hurricane or earthquake, to investors in financial markets, who receive attractive returns in exchange for agreeing to absorb losses if the specified disaster actually occurs. Developed partly in response to the enormous strain Hurricane Andrew placed on traditional insurance and reinsurance markets in 1992, catastrophe bonds represented a genuinely creative expansion of who, exactly, could participate in humanity's ancient project of sharing large risk. The tension of catastrophe bonds lies in their own novelty, blending insurance and investment in a way that requires investors to understand and accept genuinely unfamiliar risks in exchange for genuinely unfamiliar rewards. In their own modern, complex way, catastrophe bonds simply widen the ancient circle of shared risk a little further, inviting global capital markets to stand quietly alongside ordinary policyholders in bearing nature's occasional, overwhelming fury. Weather derivatives, closely related in spirit to parametric insurance, developed through the final years of the 20th century to help businesses manage financial risk tied not to catastrophic disaster, but to more ordinary, everyday fluctuations in weather. An energy company facing an unusually mild winter or a farmer facing a slightly drier than average growing season could use these instruments to soften the financial impact of weather that fell short of true disaster but still meaningfully affected their bottom line. Unlike traditional insurance, which typically requires a demonstrable loss before paying a claim, weather derivatives pay out based purely on measured weather data itself, offering a faster and more flexible tool for managing everyday climate-related uncertainty. The tension of these instruments lies in their subtlety, addressing not the dramatic catastrophes that dominate most of our story tonight, but the quieter, more persistent uncertainty of ordinary seasonal variation that businesses have always had to somehow absorb. Even in this quiet, technical corner of modern finance, the same old instinct persists, softening uncertainty, however large or small, by sharing it more widely than any single business could comfortably bear alone. The asbestos liability crisis that unfolded gradually through the later 20th century tested the insurance industry in an unusually slow and drawn-out way, quite different from the sudden shock of an earthquake or a hurricane. The companies that had manufactured or used asbestos decades earlier faced enormous liability claims as the material's serious long-term health effects became fully understood, and insurers who had written liability policies years or even decades before found themselves facing claims of a scale and duration few had ever anticipated. This slow-motion catastrophe forced insurers, including Lloyd's of London itself, to reckon carefully with how policies written in one era could create obligations extending many decades into an unforeseen future. A sobering lesson in the true, sometimes uncomfortable length of insurance's promises. The tension of the asbestos crisis lingers as an important lesson for the entire industry, a reminder that some risks unfold not in a single dramatic moment, but slowly, quietly, across an entire human lifetime or more. Even from this difficult chapter, though, the industry drew forward lessons about long-term reserving and careful, patient responsibility that continue shaping how insurers think about slow-moving risk even today. No-fault automobile insurance emerged in several countries and American states through the middle decades of the 20th century, offering an alternative to the traditional system of assigning blame before compensating an accident victim. Under a no-fault system, an injured driver's own insurance company pays for their medical costs and other losses regardless of who technically caused the accident, avoiding the slow, costly, and often bitter process of legal argument over fault that traditional liability systems required. Proponents argued this approach delivered help to injured people more quickly and reduced the enormous legal costs embedded in traditional systems, while critics worried it might reduce accountability for genuinely careless driving. The tension of no-fault insurance echoes, once again, the same old trade-off we saw earlier in workers' compensation reform. Speed and certainty of help, exchanged for a softer, less individually precise assignment of blame. Different regions continue to strike this balance differently even today, each simply choosing their own particular point along a spectrum insurance has been quietly navigating since its very earliest days. Extended warranties and service contracts, though not always legally classified as insurance, operate on remarkably similar principles, offering consumers a fixed, predictable cost today in exchange for protection against unpredictable repair expenses in the future. These products grew enormously popular through the later 20th century, alongside the rise of complex consumer electronics and appliances, whose repair costs could sometimes rival or even exceed the price of the original item itself. Retailers and manufacturers found extended warranties a profitable business precisely because most products, most of the time, do not actually break down within the warranty period, echoing the very same underlying mathematics that has supported insurance companies since the earliest actuarial tables. The tension surrounding extended warranties is a genuinely practical one for ordinary consumers, requiring a careful, personal judgment about whether the peace of mind purchased is truly worth its price, a small, everyday echo of the very same calculation merchants have made for thousands of years. Even in something as modest as a warranty on a household appliance, the ancient shape of insurance quietly persists, offered now in the aisles of ordinary stores rather than the trading halls of ancient ports. Imagine a modern consumer standing in an electronics store, quietly weighing whether to purchase an extended warranty on a new appliance, running through the same basic mental arithmetic a Phoenician sailor once used when deciding how much cargo to risk on a single ship. This small, everyday moment captures something genuinely lovely about the full arc of our story tonight. The instinct to soften uncertainty with a little advance payment has never really been reserved for merchants, sailors, or corporations alone, but belongs, quietly, to absolutely everyone who has ever had something worth protecting. Whether the stakes are a cargo ship worth a fortune or a household appliance worth a few $100s, the underlying emotional logic remains exactly, tenderly the same. The tension between spending a little now for peace of mind or risking a larger loss later for the sake of saving a little today has quietly shaped human decision-making since long before anyone ever wrote the word insurance down at all. It is, perhaps, one of the most universal and least remarked upon threads running through the entire span of economic history. Whole life and term life insurance, two distinct approaches that matured through the 20th century, offered families genuinely different ways of thinking about the same underlying need for financial protection after death. Term life insurance provides coverage for a fixed period of years at a comparatively low cost, well suited to protecting a family during the specific years when children are young and financial obligations are highest, while whole life insurance provides coverage for an entire lifetime, often combined with a modest savings component that slowly builds value over time. Insurance companies and financial advisors have debated for generations which approach best serves an ordinary family's needs, a debate that continues quietly in living rooms and financial planning offices around the world even today. The tension between these two approaches is really a tension about time itself, weighing the comparative value of cheaper, temporary protection during a family's most vulnerable years against the steadier, lifelong reassurance of coverage that never has to be renewed or requalified for. Whichever path a family eventually chooses, both simply represent different modern shapes of the very same ancient promise first offered by London's Amicable Society more than 3 centuries ago. Group insurance, purchased collectively through an employer or another large organization rather than individually, developed steadily through the 20th century, offering many working families their very first access to affordable life and health coverage. By pooling an entire workforce together into a single risk group, employers could negotiate considerably better rates than any individual employee could typically obtain alone, extending the ancient benefit of shared risk to millions of ordinary working families through the simple structure of their daily employment. This arrangement grew especially significant in the United States following the Second World War, as wartime wage controls encouraged employers to offer health benefits instead of higher salaries, gradually establishing employer-provided insurance as a defining feature of American working life. The tension of group insurance lies quietly in its very structure, tying essential financial protection to continued employment in a way that can leave workers vulnerable during job loss or career transition, precisely the moments when they may need protection most. Even with this imperfection, group insurance extended the old, gentle promise of shared protection to an enormous number of people who might otherwise never have been able to afford it entirely on their own. Unemployment insurance, distinct from the broader social insurance programs we visited earlier tonight, developed its own careful history through the 20th century, addressing one of the oldest and most universal economic fears of all, the sudden involuntary loss of one's livelihood. Early unemployment insurance schemes appeared in a handful of European cities and trade unions in the late 19th and early 20th centuries, often organized by the very same friendly societies and labor organizations that had already been providing sickness and burial benefits to their members. Britain's National Insurance Act of 1911 and the American Social Security Act of 1935 both eventually incorporated unemployment protection into their broader social insurance frameworks, recognizing that involuntary joblessness deserved the same careful, collective cushioning as illness or old age. The tension of unemployment insurance has always involved a careful balance, providing genuine support during hardship while trying not to discourage the return to work once suitable opportunities became available again. Even this quiet, often overlooked corner of the welfare state carries the same old thread running through everything else we have discussed tonight: the recognition that misfortune, even the misfortune of losing one's job, is easier borne when shared across a wider, willing community. The Lloyd's market itself endured a genuinely difficult crisis in the final decades of the 20th century, when a wave of enormous claims, including asbestos liabilities and severe natural catastrophes, pushed many of its individual underwriting members towards serious financial hardship. Traditionally, Lloyd's had relied on wealthy individuals, known as names, who pledged their entire personal fortunes as backing for the risks they underwrote, a system dating back in spirit to the very earliest coffeehouse underwriters signing beneath a single risky voyage. When claims mounted unexpectedly high through the 1980s and into the 1990s, many of these individual names faced genuinely devastating personal losses, a painful reminder that even the world's most storied insurance institution was not immune to the harsh mathematics of underestimated risk. The tension of this crisis forced Lloyd's to fundamentally reform its own structure, gradually shifting toward corporate capital backing rather than relying so heavily on individual, unlimited personal liability. Even Lloyd's, the very institution where our story once paused beside its warm candlelit coffeehouse tables, needed to learn and relearn the same hard lessons about caution and careful reserving that every generation of insurers before it had also, eventually, been forced to learn. Reinsurance and primary insurance today work together as a single, quietly cooperative system, spreading risk not just among ordinary policyholders but through multiple careful layers of protection stacked one on top of another. A homeowner's premium might first be pooled with thousands of other homeowners by a primary insurer, whose own accumulated risk is then further shared with reinsurers, who may themselves share portions of that risk with even larger global reinsurance pools spanning multiple continents. This layered structure means that even a truly catastrophic regional disaster is ultimately absorbed not by any single company or community, but by an enormous, carefully diversified network stretching quietly across the entire world. The tension of managing such a layered, interconnected system requires extraordinary coordination and trust between institutions that may never interact directly with any single policyholder at all. It is, in the end, simply the largest and most elaborate expression yet of the very same idea that first appeared among Rhodian sailors sharing the cost of a single jettisoned cargo more than 2,000 years ago. Insurance literacy programs and financial education initiatives expanded considerably in the early 21st century as governments, schools, and community organizations recognized that understanding insurance had become an essential, if often overlooked, life skill for navigating the modern economic world. Many young adults, entering the workforce and making their first independent financial decisions, historically received little formal guidance on how to evaluate health, auto, or renter's insurance policies, despite the significant financial consequences these choices could carry. Community organizations and financial educators gradually developed simpler, more accessible resources to help ordinary people navigate these decisions with genuine confidence, echoing the same slow push toward transparency and plain language we saw earlier tonight in regulatory reform. The tension of insurance literacy reflects something quietly important about the entire history we have traced together. A system built on trust functions best when the people relying on it genuinely understand what they are trusting in, slowly, patiently. This understanding continues to spread, carrying the ancient promise of shared protection a little further into the hands of ordinary people, equipped to use it wisely. As artificial intelligence and machine learning tools became more deeply woven into insurance underwriting through the early 21st century, the industry faced fresh and genuinely difficult questions about fairness, bias, and transparency in how risk was calculated. Algorithms trained on historical data could inadvertently absorb and repeat old patterns of unfairness, charging certain communities more, not because of any genuine difference in risk, but because of biased patterns quietly buried within decades of historical claims data. Regulators and insurers alike began working carefully through these difficult questions, seeking ways to harness the genuine benefits of faster, more precise risk calculation while guarding against the old human unfairness such systems could otherwise simply repeat at a much larger and more invisible scale. The tension of this modern challenge feels, in its own way, deeply familiar to anyone who has followed our story from its beginning tonight. New tools bringing new power, and new power requiring new, careful wisdom to use fairly and gently. It is, perhaps, simply the latest test of an old question insurance has faced in every century we have wandered through together: how to price uncertainty honestly, without quietly punishing anyone for circumstances entirely beyond their own control. Global development organizations increasingly turn toward insurance-based tools in the early 21st century as a way of helping the world's most vulnerable communities build genuine resilience against climate shocks, natural disasters, and economic hardship. Programs combining microinsurance, parametric triggers, and international development funding now help farmers, small business owners, and entire communities in some of the world's poorest regions recover more quickly from droughts, floods, and storms than unprotected communities ever could on their own. These programs often blend ancient and modern elements together in a single design, using satellite weather data and mobile banking technology to deliver a form of protection whose underlying spirit would be instantly recognizable to a Roman burial society or a medieval craft guild. The tension of extending genuine protection to the world's poorest communities remains an ongoing, unfinished project, requiring patient, sustained cooperation between governments, insurers, and international organizations working carefully together. It is in many ways one of the most hopeful modern chapters in this entire long story, carrying humanity's oldest financial comfort to precisely the people who have historically had the least access to it. Insurance, across every century and every culture we have wandered through together tonight, has consistently proven itself to be one of humanity's quietest and most persistent inventions, rarely celebrated with the same fanfare as a great empire or a great discovery, and yet steadily present beneath almost every major achievement of settled, cooperative civilization. Trade routes could stretch further because merchants no longer had to risk everything on a single voyage. Cities could grow denser because fire no longer meant total, unrecoverable ruin. Families could plan further into the future because illness and old age no longer meant certain poverty. Beneath the surface of nearly every steady, confident human achievement across these 3,000 years, some quiet form of shared risk was patiently, invisibly doing its gentle work. The tension between vulnerability and protection, the very first tension we encountered beside the ancient rivers of Babylon, has simply kept finding new expressions across every century since. Never fully resolved, but always, patiently, made a little more bearable. And so, as our long journey through this history finally nears its close tonight, it is worth simply pausing to appreciate how much quiet, patient cooperation it has actually taken to make the modern world feel even remotely safe to live in. As our story tonight draws quietly toward its close, it is worth remembering just how many different hands helped build this long, unbroken thread across the centuries. Babylonian scribes, Rhodian sailors, Roman burial society members, Genoese underwriters, London coffeehouse merchants, careful astronomers, working-class friendly society members, cautious government ministers, and modern micro-insurance farmers alike. None of them set out to build a single grand global system. Each simply responded, patiently and practically, to the particular uncertainties of their own place and time. And yet somehow, across 3,000 years of scattered human effort, those countless small, local responses gradually wove themselves into something remarkably continuous, remarkably universal, and remarkably tender at its core. This is what makes the full sweep of insurance history so quietly moving to consider all at once. It is, in the end, simply a very long, very patient record of people choosing, again and again, to help carry each other's uncertainty. And on that quiet, steady note, let your own thoughts settle gently now as we bring tonight's story to its close. Tonight we followed the long, unhurried thread of insurance from the sun-baked river valleys of ancient Babylon, where merchants first agreed to forgive a debt lost to storm or bandit, all the way through the marble halls of Rome, where burial societies quietly promised dignity to even the poorest of citizens. We wandered through the narrow stone streets of medieval Genoa and Venice, watching merchants divide risk across many ships and many hands, and settled for a while beside the warm, candlelit tables of Lloyd's coffeehouse, where underwriters first signed their names beneath the risks they were willing to share. We stood beside the smoking ruins of London after the Great Fire and beside the trembling streets of San Francisco after its terrible earthquake, watching each catastrophe slowly, painfully teach a wiser and more careful approach to shared protection. We followed careful mathematicians tracing mortality by candlelight, working-class friendly societies gathering in modest halls, and government ministers building entire welfare states from the same old instinct toward mutual care, before finally arriving in our own modern age of satellites, supercomputers, and microinsurance reaching the world's poorest farmers. Through every century and every culture we visited tonight, the same gentle human truth kept quietly reappearing. That uncertainty is easier to carry when it is carried together. If you are still awake, there is another sleepy economic story waiting quietly for you whenever you are ready to hear it. Another thread of history to help ease you toward rest on some future night. For now, though, if tonight's story helped your thoughts settle even a little, consider leaving the video a like, subscribing to the channel, or leaving a gentle comment below sharing which part of the story stayed with you longest. Let your jaw loosen now, your shoulders sink a little further into wherever you are resting, your breathing slow and steady and unhurried. Picture, if it helps, a quiet evening light settling gently over a still, calm harbor, ships resting safely at anchor, their long day's risk finally, peacefully done. Sleep well and good night.